Chapter 4. Is the market efficient? By the coming of the 1970s, nearly all of my investment philosophy was firmly in place, molded by my experience of 4 prior decades. It is not coincidence that with only one exception, all of both the wise and the foolish actions I have mentioned as examples that helped form the background of this philosophy were incidents that occurred during these 4 prior decades. This does not mean that I have made no mistakes in the 1970s. Unfortunately, it seems that no matter how much I try, sometimes I must stub my toe more than once in the same way before I truly learn. However, in the examples I have used, I usually took the first instance when a particular type of event happens to illustrate my point, which explains why all but one of the examples I used occurred during these earlier periods. It might be helpful to notice the striking parallels in each of these past 10-year periods. With the possible exception of the 1960s, there has not been a single decade in which there was not some period of time when the prevailing view was that external influences were so great, and so much beyond the control of individual corporate managements, that even the wisest common stock investments were foolhardy and perhaps not for the prudent. In the 1930s, there were years when this view, influenced by the Great Depression, was at its most extreme, but perhaps not any more than the fear of what the German war machine and World War II might do in the 1940s, or the certainty that another major depression would hit in the 1950s, or fear of inflation, hostile government actions, etc. in the 1970s. Yet every one of these periods created investment opportunities that seemed almost incredible with all the advantages of hindsight. In each of these 5 decades, there were not a few but many common stock opportunities that 10 years later yielded profits running to many hundreds of % for those who had bought and stayed with the shares. In some instances, profits ran well into the thousands of %. Again, in every one of these 5 decades, some stocks which were the speculative darlings of the moment were to prove the most dangerous kind of trap for those who blindly followed the crowd rather than those who really knew what they were doing. All of these 10-year periods essentially resembled the others in that the greatest opportunities came from finding situations that were extremely attractive but that were undervalued because at that particular moment, the financial community had significantly misjudged the situation. As I look back on the various forces that buffeted the securities market over this 50-year period and at the great waves of public optimism and pessimism that succeeded each other over this time span, the old French proverb, plus ca change, plus c'est la même chose, the more things change, the more they remain the same, comes to mind. I have not the slightest doubt that as we enter the emerging decade of the 1980s, with all the problems and the prospects that it now offers, the same will continue to hold true. The fallacy of the efficient market. In the last few years, too much attention has been paid to a concept that I believe is quite fallacious. I refer to the notion that the market is perfectly efficient. Like other false beliefs in other periods, a contrary view may open up opportunities for the discerning. For those unfamiliar with efficient market theory, the adjective efficient does not refer to the obvious mechanical efficiency of the market. A potential buyer or seller can get his order to the market where a transaction can be executed very effectively within a matter of a couple of minutes. Neither does efficiency refer to the delicate adjustment mechanism which causes stock prices to move up or down by fractions of a point in response to modest changes in the relative pressure of buyers and sellers. Rather, this concept holds that at any one time the market-efficient prices are assumed to reflect fully and realistically all that is known about the company. Unless someone has some significant illicit inside information, there is no way genuine bargains can be found. Since the favorable influences that make a potential buyer believe that an attractive situation exists are already reflected in the price of stock. If the market was as efficient as it has become fashionable to believe, and if important opportunities to buy or significant reasons to sell were not constantly occurring, stock returns should not subsequently have the huge variations that they do. By variation, I am not referring to changes in prices for the market as a whole, but rather the dispersion of relative price changes of one stock against another. If the market is efficient in prospect, then the nexus of analysis that leads to this efficiency must be collectively poor. Efficient market theory grew out of the academic school of random walkers. These people found that it was difficult to identify technical trading strategies that worked well enough after transactions costs to provide an attractive profit relative to the risks taken. I don't disagree with this. As you have seen, I believe that it is very, very tough to make money within and out trading based on short-term market forecasts. Perhaps the market is efficient in this narrow sense of the word. Most of us are or should be investors, not traders. We should be seeking investment opportunities with unusual prospects over the long run and avoiding investment opportunities with poorer prospects. This has always been the central tenet of my approach to investments in any case. I do not believe that prices are efficient for the diligent, knowledgeable, long-term investor. Directly applicable to this is an experience I had in 1961. In the fall of that year, as in the spring of 1963, I undertook the stimulating duty of substituting for the regular finance professor in teaching the senior course of investments at Stanford University's Graduate School of Business. The concept of the efficient market was not to see the light of day for many years to come and had nothing to do with my motivation in the exercise I am about to describe. Rather, I wanted to show these students in a way they would never forget that the fluctuations of the market as a whole were insignificant compared to the differences between the changes in price of some stocks in relation to others. I divided the class into two groups. The first group took the alphabetical list of stocks on the New York Stock Exchange, starting with the letter A, the second group, those starting with the letter T. Every stock was included in alphabetical order except preferreds and utilities, which I consider to be a different breed of cats. Each student was assigned 4 stocks. Each student looked up the closing price as of the last day of business of 1956, adjusted the stock dividends and stock splits, rights were ignored as not having sufficient impact to be worthy of the additional calculations, and compared this price with the price as of Friday, October 13th, if nothing else, a colorful closing date. The percentage increase or decrease that occurred in each stock over this period of almost 5 years was noted. The Dow Jones averages rose from 499 to 703, or by 41% in this period. Altogether, there were 140 stocks in this sample. The results are displayed in the following table. These data are quite insightful. In a period when the Dow Jones averages rose 41%, 38 stocks, or 27% of the total, showed a capital loss. 6 of them, or 4% of the total, recorded a loss of over 50% of their total value. In contrast, roughly 1/4 of the stocks realized capital gains that would have been considered spectacular. To drive the point home, I noted that if a person invested $10,000 in equal amounts in the 5 best stocks on this list at the outset of this 4 3/4 year period, his capital would now be worth $70,260. On the other hand, if he had invested the $10,000 in the 5 worst stocks, his capital would have shrunk to $3,180. These extreme results were most unlikely. It would take luck, either good or bad, as well as skill, to hit either of these extremes. It would not be so implausible for a person with real investment judgment to have picked 5 out of the 10 best stocks for his $10,000 investment, in which case his net worth on Friday the 13th would have been $52,070. Similarly, some investors consistently select stocks for the wrong reasons and manage to pick lemons. For them, selecting 5 out of the 10 poorest in performance is also not an entirely unrealistic expectation of results. In that case, the $10,000 investment would have shrunk to $4,270. On the basis of this comparison, there might be, in less than 5 years, a difference of $48,000 between a wise and an unwise investment program. A year and a half later, when I also taught this same course, I repeated the exact same exercise, with the exception that instead of using the letters A and T, I selected 2 different letters in the alphabet from which to form the sample of stocks. Again, over a 5-year time frame, but with a different starting and a different closing date, the degree of variation was almost exactly the same. Looking back on most markets of 5-year duration, I believe that one can find stock performance results that are about as disparate. Some of this dispersion may come as the result of surprises, important new information about a stock's prospects that could not be reasonably foreseen at the outset of the period. Most of the differences, however, can be anticipated at least roughly, both in terms of direction and general magnitude of gains and losses relative to the market. The Raychem Corporation. In view of this kind of evidence, it is hard for me to see how anyone can consider the stock market efficient, again using the word efficient as it is used by the proponents of this theory. But to belabor the point further, let me take a stock market situation of just a very few years ago. In the early years of the 1970s, the shares of the Raychem Corporation had considerable prestige in the marketplace and were accordingly selling at a relatively high price-earnings ratio. Some of the reasons warranting this prestige may be perceived by some comments made by the company's executive vice president, Robert M. Halperin. In outlining what he called the 4 cardinal points to Raychem's operating philosophy, he stated, 1. Raychem will not do anything technically simple, that is, something that would be easy for potential competitors to copy. 2. Raychem won't do anything unless it can be vertically integrated, that is, Raychem must conceive the product, manufacture it, and sell it to the customer. 3. Raychem won't do anything unless there is a substantial opportunity for real proprietary protection, which generally means patent protection. Unless this occurs, research and development energies will not be employed on a project, even though otherwise it might fit into Raychem's skills. 4. Raychem will only go into new products when it believes it can become the market leader in whatever niche, sometimes smaller, sometimes larger, that product attempts to capture. By the mid-1970s, awareness of these unusual strengths was sufficiently prevalent among those who controlled large institutional funds, so that sizable blocks of shares had been taken out of the market by people who believed that Raychem was a situation of unusual competitive strength and attractiveness. However, it was another aspect of this company that gave Raychem its greatest appeal to these holders and was probably the cause of the high price-earnings ratio at which it was then selling. Many considered that Raychem, which was spending an above-average percentage of sales on new project development, had perfected a research organization capable of producing an important enough stream of new products, so that the company could be depended on to show an uninterrupted upward trend in sales and profits. These research products had quite justifiably a special appeal to the financial community because many of the newer ones only indirectly competed with older products of other companies. Primarily, the new products enabled high-priced labor to do the same job in considerably less time than had previously been required. There were enough savings offered to the ultimate customer of these products to justify a price which should afford Raychem a pleasing profit margin. All this caused the stock toward the end of 1975 to reach a high of over $42.5 price adjusted for subsequent stock splits, a level about 25 times the estimated earnings for the fiscal year ending June 30, 1976. Raychem dashed expectations and the crash. Toward the close of the June 30, 1976 fiscal year, Raychem was hit by 2 hammer blows which were to play havoc with the price of the stock and with the company's reputation in the financial community. The financial community had become very excited about a proprietary polymer, styrene, which enjoyed unique advantages over other compounds used by the airplane industry for coating wire and which was then in the final research stages. Furthermore, the polymer was to be the first product in which Raychem would go basic, that is, make the original chemicals in its own plant rather than buying raw materials from others and compounding them. Because of the appeal of the product, Raychem had allocated by a considerable margin more funds to this research product than to any other in its history. The financial community assumed this product was already on its way to success, and after passing through the usual learning curve experienced by all new products, it would become highly profitable. Actually, quite the opposite was occurring. In the words of the Raychem management, styrene was a scientific success but a commercial failure. Improved products of an able competitor, while technically not as desirable as styrene, proved adequate for the job and were far cheaper. Raychem management recognized this. In the course of a relatively few weeks, management reached the painful decision to abandon the product and write off the heavy investments made in it. The resulting charge to earnings for that fiscal year was some $9.3 million. This charge-off caused earnings, exclusive of some offsetting special gains, to drop to 8 cents a share from $7.95 the previous fiscal year. The financial community was as much upset by the erosion of the great confidence in the company's research ability as by the precipitous drop in earnings. Largely ignored was the basic rule that some new product developments are bound to fail in all companies. This is inherent in all industrial research activity and in a well-run company is far more than offset in the long run by other successful new products. It may have been just bad luck that the particular project on which the most money had been spent had been the one to fail. At any rate, the effect on the stock price was dramatic. By the fourth quarter of 1976, the stock had dropped to a low of approximately $14.34, again adjusted for subsequent splits amounting to 6-to-1, or to approximately one-third its former high. Of course, only a tiny amount of stock could be bought or sold at the low point for the year. Of greater impact, the stock was available at prices only moderately above this low level for months thereafter. Another development also affected the profits of the company at this moment and contributed to Raychem's fall from favor. One of the most difficult tasks for those responsible for the success of any growing company is to change the management structure appropriately as the company grows to allow for the difference between what is needed for proper control of small companies and optimum control of big companies. Until the end of the 1976 fiscal year, Raychem management had been set up along divisional lines based largely on manufacturing techniques, that is, on the basis of the products produced. This worked well when the company was smaller, but was not conducive to serving the customer most efficiently as the company was growing. Therefore, at about the end of the 1975 fiscal year, top Raychem management started working on a big company management concept. The firm restructured the divisions by the industry served rather than by the physical and chemical composition of the products being manufactured. The target date to make the change was set at the end of the 1976 fiscal year. This was done at a time when there was not the least thought within the management that this date would coincide with the time of the huge write-off for the abandonment of Stylin. Everyone in Raychem knew that when the organizational change was to occur there would be at least 1 quarter and probably a minimum of 2 of substantially reduced earnings. While making these changes caused almost no change in the individuals on the Raychem management payroll, so many people now had different superiors, different subordinates, and different coworkers with whom they had to interface their activities that a time of inefficiency and adjustment was bound to occur until Raychem employees learned how best to coordinate their work with the new faces with whom they were now dealing. Perhaps no stronger indication could have existed to justify long-range confidence in this company or to indicate that management was not concerned with short-term results than its decision to go ahead with this project as planned rather than to postpone what was bound to be a second blow to Raychem's current earnings. Actually, this significant change worked with considerably less difficulty than had been anticipated. As expected, the first quarter earnings of the new fiscal year were much lower than would have been the case if the change had not been made. However, the change was working so well that as the second quarter progressed, the short-term costs of what had been done had largely been eliminated. Fundamentally, these developments should have been considered bullish by analysts. Raychem was now in a position to handle growth properly in a way that could not have been done before. It had successfully hurdled a barrier of the type that is most apt to dull the luster of otherwise attractive growth companies. By and large, the financial community did not seem to recognize this, however, and instead the temporary further shrinkage of earnings was just one more factor holding the stock at the low levels to which it had fallen. Making these price levels even more attractive to potential investors was another influence that I have seen happen in other companies shortly after they had abandoned a major research project that had proved unsuccessful. One financial effect of the abandonment of Stylin was that a sizable amount of money that had heretofore been devoted to that project was now free to be allocated elsewhere. Even more important, it had similarly freed the time of key research people for other endeavors. Within a year or two, much like a field of flowers starting to bloom when rain follows drought, the company began to enjoy what was possibly a greater number of attractive research projects in relation to its size than had ever before been experienced. Raychem and the efficient market. Now, what has Raychem's situation to do with this theory of an efficient market that has recently gained such a following in certain financial quarters? According to that theory, stocks automatically and instantly adjust to whatever is known about a company so that only those who might possess illicit inside information that is not known to others could benefit from what might lie ahead for a particular stock. In this instance, at the drop of a hat, the Raychem management would and did explain to anyone interested all the facts I have just cited and explained how temporary they believed was the period of poor earnings. Actually, well, after all this had happened and when profits were climbing to a new all-time high level, the Raychem management went even further. On January 26, 1978, they held a long one-day meeting at their headquarters which I had the privilege of attending. Raychem management invited to this meeting the representatives of all institutions, brokerage houses, and investment advisors who either had any interest in Raychem or they thought might have. At this meeting, the 10 most senior executives of Raychem explained with what I believe was extreme frankness and in detail, such as I have only occasionally seen at similar meetings of other companies, the prospects, the problems, and the current status of Raychem matters under their jurisdiction. In the year or two following this meeting, Raychem's earnings growth developed exactly as might have been inferred from what was said there. During that period, the stock was to much more than double from the price of $23.14 at which it was selling that day. Yet in the weeks immediately following this meeting, there was no particular effect on the stock whatsoever. Some of those present were obviously impressed by the picture being presented. Too many, however, were still under the influence of the double shock that they had experienced a year or two before. They obviously mistrusted what was being told them then. So much for the theory of an efficient market. What kind of conclusion does the investor or the investment professional reach from experiences like Raychem? By and large, those who have accepted and been influenced by this theory of the efficient market fall into two groups. One is students who have had a minimum of practical experience. The other, strangely enough, seems to be many managers of large institutional funds. The individual private investor, by and large, has paid relatively little attention to this theory. From this experience gained in applying my personal investment philosophy, I would conclude that in my field of technological stocks, as the decade of the 1970s comes to an end, there would therefore be more attractive opportunities among the larger companies, the market for which is dominated by the institutions, than among the small technological companies where the individual private investor plays a considerably bigger role. Just as some 10 years earlier those who recognized the folly of the then prevailing concept of the two-tier market benefited from recognizing that particular nonsense for what it was, so in each decade false ideas arise, creating opportunities for those with investment discernment. Conclusion. This then is my investment philosophy as it has emerged over a half-century of business experience. Perhaps the heart of it may be summarized in the following 8 points. 1. Buy into companies that have disciplined plans for achieving dramatic long-range growth in profits and that have inherent qualities making it difficult for newcomers to share in that growth. There are so many details, both favorable and unfavorable, that should also be considered in selecting one of these companies that it is obviously impossible in a monograph of this length to cover them adequately. For those interested, I have attempted to summarize this subject as concisely as I could in the first 3 chapters of Conservative Investors Sleep Well. A brief outline appears in the appendix. 2. Focus on buying these companies when they are out of favor, that is, when, either because of general market conditions or because the financial community at the moment has misconceptions of its true worth, the stock is selling at prices well under what it will be when its true merit is better understood. 3. Hold the stock until either A. There has been a fundamental change in its nature, such as a weakening of management through changed personnel, or B. It has grown to a point where it no longer will be growing faster than the economy as a whole. Only in the most exceptional circumstances, if ever, sell because of forecasts as to what the economy or the stock market is going to do, because these changes are too difficult to predict. Never sell the most attractive stocks you own for short-term reasons. However, as companies grow, remember that many companies that are quite efficiently run when they are small fail to change management style to meet the different requirements of skill big companies need. When management fails to grow as companies grow, shares should be sold. 4. For those primarily seeking major appreciation of their capital, de-emphasize the importance of dividends. The most attractive opportunities are most likely to occur in the profitable but low or no dividend payout groups. Unusual opportunities are much less likely to be found in situations where high percentage of profits is paid to stockholders. 5. Making some mistakes is as much an inherent cost of investing for major gains as making some bad loans is inevitable in even the best run and most profitable lending institution. The important thing is to recognize them as soon as possible, to understand their causes, and to learn how to keep from repeating the mistakes. Willingness to take small losses in some stocks and to let profits grow bigger and bigger in the more promising stocks is a sign of good investment management. Taking small profits in good investments and letting losses grow in bad ones is a sign of abominable investment judgment. A profit should never be taken just for the satisfaction of taking it. 6. There are a relatively small number of truly outstanding companies. Their shares frequently can't be bought at attractive prices. Therefore, when favorable prices exist, full advantage should be taken of the situation. Funds should be concentrated in the most desirable opportunities. For those involved in venture capital and quite small companies, say with annual sales of under $25 million, more diversification may be necessary. For larger companies, proper diversification requires investing in a variety of industries with different economic characteristics. For individuals, in possible contrast to institutions and certain types of funds, any holding of over 20 different stocks is a sign of financial incompetence. 10 or 12 is usually a better number. Sometimes the costs of the capital gains tax may justify taking several years to complete a move toward concentration. As an individual's holdings climb toward as many as 20 stocks, it nearly always is desirable to switch from the least attractive of these stocks to more of the attractive. It should be remembered that ERISA stands for emasculated results, insufficient sophisticated action. 7. A basic ingredient of outstanding common stock management is the ability neither to accept blindly whatever may be the dominant opinion in the financial community at the moment nor to reject the prevailing view just to be contrary, for the sake of being contrary. Rather, it is to have more knowledge and to apply better judgment in thorough evaluation of specific situations and the moral courage to act in opposition to the crowd when your judgment tells you are right. 8. In handling common stocks, as in most other fields of human activity, success greatly depends on a combination of hard work, intelligence, and honesty. Some of us may be born with a greater or lesser degree of each of these traits than others. However, I believe all of us can grow our capabilities in each of these areas if we discipline ourselves and make the effort. While good fortune will always play some part in managing common stock portfolios, luck tends to even out. Sustained success requires skill and consistent application of sound principles. Within the framework of my 8 guidelines, I believe that the future will largely belong to those who, through self-discipline, make the effort to achieve it.